Earned wage access, often called on-demand pay, is a financial service that allows employees to access part of the wages they have already earned before their official payday. In simple words, it means workers do not have to wait until the end of the week or month to get paid. They can withdraw money they have already worked for when they need it. Traditionally, wages have been paid on fixed schedules, like every 2 weeks or once a month. This system made sense for employers, who could process payroll in batches. But for workers, it often created financial stress. If an unexpected expense appeared between paychecks, many had to rely on credit cards, overdrafts, or payday loans, which can be very expensive. Earned wage access emerged in the 21st century as a way to give employees more flexibility and reduce reliance on high-cost debt. Economically, earned wage access is about liquidity and timing. Workers already own the wages they have earned. They just do not have access to them yet. By allowing earlier access, employers or third-party providers improve workers' cash flow. For employers, this can mean higher employee satisfaction, reduced turnover, and even better productivity. For providers, it creates a business opportunity, since they may charge small fees per transaction or partner with employers as part of benefits packages. There are two main models of earned wage access. First, the employer-based model, where the company integrates earned wage access into its payroll system. Employees can withdraw part of their accrued wages directly, often through a mobile app. The employer then adjusts the balance on payday. Second, the third-party provider model, where fintech companies step in between the worker and the employer. These companies advance money to the employee based on estimated earnings, then recover it when the paycheck arrives. In this case, the service may look like a short-term advance, though usually with lower costs than payday loans. An example makes this clear. Imagine an employee has already worked 8 days in a 2-week pay cycle. Unexpectedly, their car breaks down, and they need $200 for repairs. Instead of borrowing, they use an earned wage access app to withdraw $200 of the wages they have already earned. On payday, their paycheck is reduced by that amount, minus a small transaction fee. The benefits are significant. Workers gain financial flexibility, avoid predatory loans, and feel less stress. Employers can use it as a perk to attract talent in competitive labor markets. However, there are concerns. Some worry that if workers rely too heavily on early withdrawals, they may end up short on payday, creating new financial pressures. Regulators also debate whether earned wage access should be treated like a loan, since it involves advancing money. A curiosity is that large employers like Walmart and McDonald's in the U.S. already offer earned wage access programs, and fintech firms like DailyPay, PayActiv, and Even have become leaders in this space. In some countries, governments even see it as a tool for financial inclusion, helping workers with unstable incomes manage expenses more smoothly. To summarize, earned wage access is a system that lets employees receive part of their wages before payday, improving cash flow and reducing reliance on expensive credit. It benefits both workers and employers, though it raises questions about regulation and long-term financial habits. It is one of the fastest-growing innovations in modern payroll and financial technology. Up above, I left you more videos so you can keep learning law. Remember to leave us a like and subscribe.